The risk of a financial crisis is soaring. A warning signal for dollar liquidity is at levels not seen since March of 2020, and all indicators are it's going to get even worse. Is a liquidity crisis about to hit the U.S. financial system? So, what we're looking at here is the 1 week moving average of a spread between SOFR and IORB, or interest on reserve balances. This is a difference between two different interest rates. Now, to start with here's the overnight dollar markets. Now, there's about $3 trillion financed in the overnight repo markets. Again, you don't have access to them, but money market funds, hedge funds, banks, this is their primary source of funding for the U.S. financial system. So it's very important to understand how this works. So we're going to start with defining SOFR, Secured Overnight Funding Rate. This is the cost of money, a relatively free market interest rate or cost of capital, and it reflects supply and demand. Now, think about it. If you are the only guy on Wall Street that has, say, $10 million available to loan out, and everyone else on Wall Street needs that $10 million, well, you get to charge a high interest rate. And the degree to which that interest rate is above what the Fed is trying to set interest rates at, the degree to which your interest rate is reflecting a much, much higher interest rate than what the Fed is trying to set, is reflected down here in purple. Another way of thinking about it is the chart we were just looking at. Again, the spread between two interest rates. When capital or liquidity is very, very tight, you see SOFR start to soar above the reverse repo rate, the federal funds rate, or the IORB. Now, the reverse repo rate, what this is the Fed trying to do is say, no matter how abundant dollars get, we will always buy them at 4%. And the discount window rate is kind of the reverse, which is saying no matter how tight dollars get, we will always provide them to the market at 4.25. So they're trying to set a floor and a ceiling in the cost of capital, or the price of a dollar. Now, this SOFR rate tends to spike at month end and at quarter end. So I've highlighted a couple different month ends and quarter ends, and you can see that all of the SOFR spikes coincide with either quarter end or month end. Now, the reason for this is referred to as window dressing. You can think of it as major financial firms shifting around numbers on a spreadsheet to try to make their balance sheets look good to regulators and investors. And it happens at month end, quarter end, and year end. Of course, we saw a big SOFR spike at the end of 2024. So these periods of time, it is normal to see SOFR start to spike above IORB, Fed funds, reverse repo award rate, whichever interest rate you want to pick. It is normal to see actual dollar liquidity start to tighten. Therefore, the few people that actually have dollars get to set a higher interest rate than the Fed would like. So hopefully that concept is clear. We can see that quarter end, month end, basically every single SOFR spike has coincided with quarter end or month end. Well, we've been highlighting the trend higher in SOFR for the past couple weeks and pointed out it is not month end, it is not quarter end. Now, September 15th was tax deadline, so you could expect some degree of tightening there with tax deadline, but that is long past. Now, I said it was about to get much worse. So September 28th, when we're recording this particular video, so we have 2 more days before the end of the quarter, right? Quarter 3 ends in 2 days on Tuesday. And again, generally speaking, you see liquidity conditions get worse at month end and especially at quarter end. Now, it is important to point out that this does coincide with both the VIX starting to spike. Generally speaking, the VIX will spike at month end, quarter end. You can see a number of times there with the VIX. And here is the MOVE index. Maybe not as strong a correlation with the MOVE index, but this measures bond market volatility. And we'll get into why bond yields could start to soar. There is some degree of volatility generally associated between the MOVE index, again, bond volatility, and these month end, quarter end. And again, we see the 1 week average blowing out, just absolutely going vertical, indicating that actual dollar liquidity is much worse than the Fed would probably like it to be. Now, if you're curious about learning more about this month-end, quarter-end dynamics, I will link this report in the description so you can read further in depth. But Here is that same spread that we were looking at in the first slide, SOFR minus reverse repo. It's reflecting the same exact thing. We just have more data to look at here. And what we can see is, again, this is the highest rate, both on a 14-day average and a 28-day average or a month average. This is the highest spread between these two interest rates going all the way back to March of 2020. Now, if you're wondering what this massive spike here is, this was the repo rate crisis that nearly brought down the US financial system, and the Fed had to respond, right? Actual dollar liquidity was so tight that this spread blew like 900 basis points above the federal funds rate, and indicating, again, dollar liquidity, actual liquidity was way worse than the Fed would have liked, and it led to a massive dislocation in the repo markets. Now, the Fed had to counter that by injecting liquidity, injecting dollar liquidity. How did they do that? Well, QE, basically, they increased their bank reserves, and the way they do that is just digitally printing money, basically, and they started to flood the system. Then, of course, we know what happened a couple months later. They flooded the system with even more dollar liquidity. Now, if you are curious about the tie here between SOFR and bond yields, I will link this report from the Fed. It's a speech. I will link that in the description because, as you might imagine, worse dollar liquidity coincides with higher interest rates. So as we can see here, as liquidity conditions are getting tighter and tighter and tighter, this has coincided with a rise in the 30-year Treasury yield. The same is true generally for the 10-year as well. You can look at different maturities and see at least the ones that are sensitive to liquidity conditions and not just following the Federal Reserve. Those tend higher. And the reason hopefully makes intuitive sense, which is as actual liquidity conditions become tighter, there's less money available to buy the US Treasuries. And by the way, here's a correlation coefficient. Generally speaking, over a 10-day period of time, there's a 1-to-1 correlation with tighter liquidity conditions as measured by the moving average here and the 30-year Treasury yield. So again, if you would like to see more about that, I will link that report. Now, why does this matter even more? So here's the monthly budget deficit for the federal government. And last month, our deficit came in 40% higher than expected. The expectation was $245 billion monthly deficit, and it came in at $345 billion. So an increase of $100 billion just in 1 month, above and beyond what was already expected, which was an already large deficit. Now, as a share of GDP, remember, our deficit is running at basically 7%. So what this means, remember, what the budget deficit represents is that the way for the government to fund Medicare, Social Security, the military, so on and so forth, is by issuing debt, right? And the deficit tells you how much new debt must be issued just for the government to survive. And again, with a very, very large deficit, what that means, they need buyers for their debt. We are already straining dollar liquidity. We are already starting to crowd out kind of private investment, for example, by running such large deficits. So there is a huge amount of demand that the U.S. Treasury Department and the government need for their treasury bonds, for their debt. There is, again, about $2 trillion per year of new debt that must be bought by the market. So again, this is pressuring dollar liquidity conditions even more. And again, as you can see, as SOFR, the SOFR spread, or the actual cost of capital minus subtracting out what the Fed would like it to be, this reflects that dollar liquidity conditions are getting worse. And as we can see, it's coincided with a rise in interest rates. And generally, as liquidity conditions got better, coincided with a decline in interest rates. Because again, remember that if there is more liquidity, more abundant liquidity, that liquidity can then go buy things like treasury bonds. Well, we know the amount of treasury bonds that must be bought by the market is near historical extremes of 7% of GDP outside of a recession. But wait, it gets even worse. So the Fed is engaged in quantitative tightening. And as you can see, quantitative easing is where the Fed is increasing their balance sheet, such as in 2020. What this means is the Fed is printing bank reserves and using those bank reserves to purchase securities from the banks. Well, as we can see, we have been engaged in quantitative tightening, which is the exact opposite, meaning just as bank reserves are created out of thin air during QE, they are destroyed during QT. And as if it couldn't get even worse, the TGA, this is the government's checking account or the Treasury General account. It's very simple. You can think of this as the balance on your checking account, just as you would like a buffer for a couple months of expenses, the Treasury would as well. Well, as we can see, going back to July, the TGA has been being rebuilt, or the balance has been going up. And what this is reflecting is the Treasury is sucking capital, sucking dollar liquidity out of the financial system and just storing it in their checking account. Well, again, as we can see, that's had a negative effect on bank reserves, which are, again, the half of the monetary base, or M0, are these bank reserves. They are kind of the core of dollar liquidity and the money supply, generally speaking. We can see bank reserves have plummeted. In fact, bank reserves as a share of the M2 money supply is basically at 13%. Now, we've only hit this level one other time, which was here, and the TGA had to get drained. And again, cash or dollar liquidity injected into the financial system. Now, here's another correlation coefficient, the 8-week correlation coefficient, so 2-month, between the spread of SOFR and the RRP versus bank reserves. So again, these are reflecting the same dynamic, which is a tightening of liquidity conditions. As the bank reserves are falling, that is indicating there are less dollars out there in the base of the financial system to, say, for example, buy treasury bonds, which we know the amount that need to be bought is near a record. So it gets actually even worse. So here's the reverse repo award, the reverse repo balance and SOFR volume. Again, about $3 trillion gets financed in the SOFR markets. And what we can see is the reverse repo has been being drawn down. So back here, when bank reserves were starting to, as a share of M2, reach 13%, not only was there a strong balance in the TGA that could get ran down, not only that, but the reverse repo had all this excess dollar liquidity or cash in it that could be tapped, right? So there was a storage tank of excess dollars that had been printed during 2020 and 2021 that could be ran down. Well, the reverse repo balance right now is just a paltry $48 billion. Now, what can happen here is I've highlighted again quarter end, which is approaching on Tuesday. And as we can see, reverse repo balances generally spike during quarter end. And remember, the reverse repo, what this is a Federal Reserve facility that is guaranteeing a certain interest rate for cash. The Fed is providing treasury bills as collateral to the banks or hedge funds, to the financial system. And the financial system is providing cash. And so as we can see, during quarter end, when liquidity conditions are already tight, and we saw that from SOFR Fed funds generally blowing out during month end, quarter end, well, again, we have not been in month end or quarter end for the past month or so. Well, not only that, but we have a massive deficit that needs to be financed. Otherwise, interest rates will go higher. And the Fed is engaged in quantitative tightening, meaning bank reserves are being strained. And the TGA has been rebuilding their checking account. Again, it cannot come from the RRP. It has to come from bank reserves. So we have been drawing down on the core of dollar liquidity, or the money supply, which is bank reserves. We can see are just at $3 trillion, almost dipping below $3 trillion for the first time since 2023. Not only that, but during month end, quarter end, or when liquidity conditions get tight and the banks sense, maybe counterparty risk, well, the Fed and the reverse repo is a Fed facility. That is basically risk free. You don't have to worry about your counterparty when it's the Fed. So it is seen as a way to safely park dollars. And again, in exchange, they get collateral in the form of treasury bills. But again, there's very little actual cash in here. However, if this were to spike, again, that's removing even more cash from the system. So as we can see, the VIX Here are two moving averages for the VIX. Some traders use these moving average crosses. And as we can see, the 20-day moving average is starting to cross above the 50-day moving average, indicating that the short-term trend on the VIX is starting to accelerate above and beyond the 50-day trend. This is generally seen as a turning point in a potential trend change. So the VIX could be certainly headed much higher if this moving average cross holds. And what have we seen over the past couple days? Well, Bitcoin, I want to point this out. Bitcoin topped the 18th of September and has been selling off ever since. This is the most liquidity sensitive asset, and it would be the first asset that a major financial firm would sell if liquidity conditions were getting tight. Sure enough, we know they were getting tight in early to mid-September. Well, sure enough, that was it. That was when Bitcoin topped. And not only that, but we have seen yields start to rise over the past 2 weeks across the curve, 2-year, 10-year, 30-year. And we have seen the dollar or the DXY index start to spike, again, indicating that the dollar relative to other currencies is becoming stronger. Not only that, but of course, the S&P 500 has started to sell off as well. So all of these indicators seem to point to the same thing, which is dollar liquidity conditions are already very, very tight. Everyone wants dollars and needs dollars for this upcoming window dressing at quarter end. They are all, the conditions for those that actual dollar supply are very, very tight. We know this has already been building for about a month or so. We can see that is outside of month end or quarter end, meaning it's only going to get worse. And of course, this generally coincides with higher interest rates, as we can see here. Again, as dollars are less abundant in the financial system, well, there's less dollars available to buy things like treasury bonds. Well, we know that the amount of treasury bonds that have to be bought every single year is about $2 trillion or 7% of GDP. And this comes at a time where the Fed is engaged in quantitative tightening, and the Treasury is building back up their TGA or sucking dollars out of the system. By the way, the TGA has gone from about 300 billion to 750 billion, meaning the Treasury alone has removed $450 billion from the financial system. Oh, and by the way, bank reserves are cratering down to just 3 trillion. Again, this is half of the monetary base and kind of the core of dollar liquidity for the financial system. And again, if the reverse repo balance spikes, what that means is there's even less cash available in the SOFR market as the reverse repo balance increases. What that is reflecting is financial firms are parking their cash with the Fed because they might sense counterparty risk, and therefore they want a safe option. So that is even further reduction of dollar liquidity that is being removed from the financial system and parked with the Fed. Now, this moving average cross, this could be quite significant. Here we saw the last time that this happened, the VIX went on a tear. So whether or not this holds is only a question of time. We will only be able to tell in a couple days whether that moving average cross holds, but it could be a massive turning point in trend change. We already see yields moving higher across the curve, again, indicating falling bond price. The value of the bond is falling. The yield is inverse to that, going up. Dollar index has spiked and is showing mega strength. And the S&P 500 has topped and has been selling off. Not only that, but of course, Bitcoin topped back on September 18th, one of the more liquidity sensitive or one of the first assets to get sold if a financial firm was trying to raise cash. So anyway, just some things to watch. Hopefully that was helpful, and I'll catch you in the next.